And the issue with inflation, Loulou, is we don't feel it that much. We still think, okay, we've got a million dirhams in the bank, and 5 years later, we still have the million dirhams in the bank. Actually, you don't have million dirhams in the bank anymore because the purchasing power of that million dirhams has dropped. It's a concept that some people have difficulty getting their heads around because they say, hey, I've got million dirhams. No, you don't have. Because what that million dirhams could have bought 5 years ago is far more than what is going to buy you now.
Yeah.
So that's something that people need to understand, that leaving your money in cash under the mattress, under the pillow, is not something very conducive these days.
Hi, everyone, and welcome to episode 50 of Conversations with Loulou. My guest is Binod Shankar. He's a dear friend and an expert in finance. He's worked both in corporates at an executive level, and also he's an entrepreneur, having founded Genesis Institute, which is the largest CFA prep center in the Middle East region that eventually sold to Kaplan Inc., which is a global provider of educational programs. Today, Binod is an executive coach to the C-suite. He's also working on his book, Let's Get Real, which comes out in May, and he's a regular market analyst on CNBC and Bloomberg. Binod is excellent at breaking down complex concepts, and that's why I wanted to talk to him today to tell us more about the current macroeconomic environment. What does it mean for us as business leaders, and how it may impact our day-to-day lives, especially here in the GCC. So let's tune in. How are you?
I'm good, man.
Yeah?
Yeah.
I looked up my podcast. I saw you were my guest number 9 on Conversations with Loulou back in 2020.
It's been 3 years almost.
Yeah. And
Wow.
now you're my 50th guest.
So maybe it'll become guest number 109 or something, if you go in this sequence, you never know, right?
Yeah, potentially.
Potentially.
How have you been?
Good.
Yeah?
Good to see you finally after all this COVID
I know.
lockdown and
The
things
first
like
time
that.
we did it was online. We
Just
recorded.
a Zoom or something, exactly.
You were hunkered down in your house.
Hunkered was the word.
Yeah.
Yeah.
Now better. All good.
All good.
Yeah.
Going out, meeting people,
Yeah.
and taking the opportunity to come and meet and talk and share
You're
my
working on the
thoughts.
book.
Working on the book as well. We'll probably touch upon that
Yeah,
later
we're
today
gonna
as
touch
well.
on that.
Yeah,
Let's get
yeah.
real.
Let's get real.
Let's get
Absolutely.
real.
You read the title. Good.
Yeah, of course. Look, you're a fantastic teacher. You're one of the best teachers out there.
Thank
Your students at Genesis, you were teaching everybody how to pass the CFA test, right?
Exactly,
And your
exactly.
student called you God's only gift to finance.
That's what they said. I never claimed to be God's gift to finance.
Yeah. So I want you to put your teacher hat on a little bit, and it's been a tough couple of years, right? Post COVID, we've had a lot going on in the world of finance, with interest rates going up, with everybody's kind of what's happening with the rates. Did they increase? Are they gonna increase by how much? There's inflation that's soaring. There's bank failures. There's lots of things happening around the world. So I wanted you to come here and just help us simplify.
Demystify.
Demystify, yes, please, and simplify some
sure.
of these
I'll try.
concepts, and really just tell us, what does it mean, right?
Sure.
What does it mean to me as a business leader? What does it mean to me as an entrepreneur, as an average person? Yeah, so maybe
Right.
we can start with inflation. So what is, in very simple terms, what is inflation?
Well, that's the word on everyone's mind these days, isn't it? Inflation.
Yes.
So in simple terms, Loulou, it's basically increase in the price of goods and services on a quarterly basis or on a yearly basis.
Okay.
Right? Now, that happens, you can have increases or you can have decreases. You can have inflation or you can have deflation.
Okay.
For the longest time, we had deflation, thanks to China and cheap labor. But now, over the last 2 years especially, we are looking at inflation. And inflation is not necessarily something that's good, which is why we keep hearing about it all the time. Federal Reserve, Jerome Powell, CNBC, all these people keep talking about inflation. So it's basically an increase in the price of goods and services.
Okay.
And that has massive consequences,
Okay. So things become more expensive for the average person.
pretty much.
Okay, and now it's really high. So it's nearly 5%. No, sorry. What's the inflation
So
rate at the
it keeps
moment?
changing on a month-to-month basis.
Okay.
Or the latest reading from the US was 6.5%,
Okay.
which is incredibly high compared to the average of about 1.5 or less
Okay.
over the last 20, 25 years. And that's a matter of concern, which is why everything is now focused on Fed policy and Federal Reserve policy and macroeconomics and interest rates, because inflation needs to be crushed, needs to be brought under control.
Okay, and it needs to be at what level? Like, what is an acceptable level of inflation?
Well, good question. It's like, so the Federal Reserve, which is the world's largest, most powerful central bank, says 2% inflation is the acceptable level.
Okay.
And anything above that is not good for the economy, not good for savers, not good for consumers, not good for the government itself. So they're trying hard to bring it down from 6.5% where it is now to 2%. And they've been trying to do that for the last 1 year, ever since March 2022, when they started increasing the interest rates.
So the interest rates have increased, have gone up. Now
Yes.
they're between 4.5 and 5%.
Yes, so the Federal Reserve rate is about 4.5 to 4.75%. It was 0% a year ago, so they have increased a lot in a very short time,
Yes.
which is quite unusual. But like they say, desperate situations require desperate remedies, and basically they've had to ramp up rates. And that basically happened, it's a bit of a long story, but I'll try and make it short, because they underestimated the effect of this huge funding they had to do to relieve people of the COVID issue. So way back in 2020, if you remember, the US Congress and the Federal Reserve pumped trillions of dollars, literally, into the economy to make sure that it didn't collapse under the COVID issue. That proved to be too much. It didn't have to be that much. And that what happened was you had too much money chasing too few goods, and that just exploded the inflation.
And you had supply chain issues
Exactly.
as well during COVID.
So you had a double whammy, right? You had too much demand because of too much money in the hands of consumers, because of all this money that the government is giving them away for free, and you had supply chain issues. So you had supply shortages and demand explosion, and the combination of that was something that no one expected, not the least of the Fed at least, Yeah.
Okay. So the rates have been going up.
Yes.
People are talking. Some of them say maybe there is a little bit more increase. Some people are saying it's reached the peak. How does one know, or when it will stop?
Well, one knows when inflation is happening for sure.
Okay.
You go to the grocery, you go to the supermarket, you go to take a bank loan. You know that suddenly mortgages have become unaffordable, goods have become unaffordable,
Yes.
and that's been going on for some time now. How do we know when it will stop? Well, it all goes back to what's happening in the US, to be honest, the world's largest economy. They are facing a serious labor shortage across almost every sector of the economy.
Okay.
And that's partly because of immigration issues and people not going back to work, COVID-related illnesses. There are lots of reasons why that's happening. But that's causing a situation where for every vacancy, there are almost nobody to look to apply for the jobs. So there are a lot of vacancies, not enough applicants. As a result, labor costs are going up. And because America is a service-driven economy, more than a manufacturing economy like it was 30, 40 years ago, a lot of that increase in labor cost is flowing through to the prices of goods and services and affecting all of us around the world, because America is huge and they export lots of goods and services. So that's the problem. So unless that part can be relieved in some way or form, so what the Federal Reserve is trying to do is increase interest rates to cool down the economy, to make demand come less. So when you cool down the economy, how do you do that? You raise interest rates. So what happens? Suddenly borrowing becomes expensive. Suddenly people don't want to borrow to buy a car or a house. Companies don't want to borrow that much. There's less money in the economy.
Okay.
Less money means less money chasing goods.
Okay.
So inflation hopefully comes down. So that's their ambition. How long it will take? It's like asking how long is a piece of string. It's very behavioral, Loulou, you know what I'm saying? It's not like econometricians like to think of it as a cause and effect and very neat formula. It doesn't work that way. People behave weirdly sometimes in situations. So you cannot predict human behavior.
There's like force majeure, like Russia,
Exactly.
Ukraine war. For
Who
example.
knew? Right?
Yeah.
I mean, who knew COVID would happen in
Yes.
2020 or Russia last year? And God knows what else is happening. So all these unexpected events, what do you call Taleb calls black swans.
Yeah, black swans.
Keep coming and hitting us from left and right. And so Powell is struggling to control inflation. So let's hope he does a good job of controlling inflation without killing the economy,
Yeah.
which is what people call a soft landing.
So this is also another thing that we hear about a lot, right? So we've been hearing about recession for a long time. Everybody's been talking, we're on the brink of a recession. It's coming, it's not coming. Are we headed towards a recession?
It's like the boy who cried wolf.
Okay.
Finally, when it happens, no one will believe you, right? So recession technically is, as per the US, some bureau in the US, they define recession as 2 successive quarters of declining GDP growth.
Okay.
gross domestic product. So basically, economy is slowing down over a 6-month period.
Over two, yeah.
Pretty much half the year. That hasn't happened yet.
Okay.
And the reason why the reason why it was expected to happen, let's go back to that, was the Federal Reserve started hiking rates, as I mentioned to you last year.
Yes, so people will stop investing, will
Exactly.
stop spending a lot.
Stop spending, investing, economy would slow down, eventually to a point where it becomes a recession. That was the fear. It's still the fear in many people's minds. That didn't happen. And that didn't happen because the American consumer was loaded with money from all the free goodies he got during the COVID
So
times.
they're still spending.
They're still spending like crazy, and Americans don't save much. They like to spend a lot on travel and experiences and services. Not so much goods these days. So what happened was the economy still continued to do very well. It's still doing well. But now the biggest fear, there's always a fear, right? Is that the current banking crisis, and we'll talk about that, right? The Silicon Valley Bank and Credit Suisse in Europe, that might precipitate a recession because banks are now probably feeling scared of lending money, and they'll probably lend less money. And as you know, banks are a vital engine for economic growth. If they start lending less, it's going to hit the economic growth. That's the fear of recession now, not so much from the Fed raising rates, because for 1 year, nothing has happened. So okay, maybe it won't happen.
Yeah.
But now people have to worry about something, right? So
Yeah.
now they're worrying about the banking crisis.
But the Fed is still raising rates, right? They recently raised rates.
Yes.
And there's a lot of talk about, more banks potentially collapsing basically at the weight of these increased rates that are making those long-term investments that the bank made,
Right.
bonds and so on,
Right.
worth less.
Right.
So the rates are still going up,
Correct.
which means that there's a potential that this would happen, right? The banking, like more banking collapse.
Yes. Yes and no. So
Okay.
if you compare 2008, when the
Okay.
world was about to end,
Yes.
we all remember that.
I lost my job.
Lost
The
it.
world ended for
You'll
me.
never forget that, right? To now.
Yeah.
And we had a banking crisis then, a banking crisis now. But we're looking at two different crises.
Okay.
And hence,
Explain.
explain. So in 2008, compared to now, what happened? There are 3 or 4 differences, Loulou, yeah? In 2008, what happened was banks gave bad loans, or what they call subprime loans.
Okay.
And there were trillions of dollars of the subprime loans on their balance sheets. And suddenly the property market, the bubble, which was the basis of these loans, or the loans were used to finance property acquisitions, the property market collapsed throughout the US. And suddenly banks were left holding worthless loans and worthless properties. And people were holding worthless properties. That affected their spending power, and it became a big contagion that affected the whole economy, not just Wall Street and stocks. This time round, it is not a question of bad loans. Like you said, this time round is the Federal Reserve raising rates. Because it raised rates, the bonds that the banks are holding as assets, they fall in value. And when they fall in value, suddenly they have less cash. And then it's a panic in the market. People want to pull out money as depositors. And then banks are selling their bonds, but the value of the bonds is going down. You see the problem? It becomes a vicious cycle.
Yeah.
And suddenly the Fed has to step in.
Is it more of like a PR crisis basically?
I would say it's a contagion. It's fear.
Yeah.
It's unjustified fear, to be honest.
Okay.
Because if the bank can hold those
Because
bonds.
that's what happened with Silicon Valley Bank, right?
Yes.
Like they started selling some of these long-term bonds at
Correct.
discounted rates,
Correct.
and then this whole thing.
They started selling. So when the news got out that they were selling bonds at a loss,
Yeah.
that's when I think the panic really started. Because people are saying, oh my God, they have $90 billion of bonds. If they sell all these bonds, they're going to incur massive losses. Let's take our money out.
Yeah.
And unfortunately, a lot of the deposits were by VCs and PE firms who are typically very fickle and they need cash. So they took out the money in a hurry.
Yeah.
I think in one day, $48 billion went out as deposits.
Yeah.
Which is massive.
Yeah.
So that is one difference, which is basically, right now it's a macroeconomic driven issue. Although, of course, Silicon Valley Bank had massive management failures as well.
Yeah.
Whereas 2008,
What was it? Duration mismanagement, right?
well, yeah,
Yay! Yay!
you remember your fixed income, right, and bond classes. Yeah, basically,
No, I don't. I've just been reading about it a lot.
yeah, duration mismatch. Basically, you have short-term deposits and very long-term loans, which is okay. Most banks have that,
Yeah.
but not in a scenario when interest rates are rising so rapidly.
Okay.
And that's what really, so that's one difference in terms of the cause of this. One was toxic loans, now it is interest rates.
Okay.
The second difference is that in 2008, Loulou, a lot of this mess came from the unregulated sector of the economy or the financial sector. Lehman Brothers was an investment bank, not really well regulated.
Okay.
AIG, American Insurance Group, was an insurance, not that well regulated. Bear Stearns was a hedge fund, which are typically never that regulated anyway.
Okay.
But they were holding hundreds of billions of dollars of toxic loans and derivatives. This time around, it's happening in a regulated sector, banking. And that's very different because people have eyes on what's happening. There's transparency and there's visibility, right?
Okay.
The third point is connected to the second point, which is that after 2008, some people woke up, US Congress woke up,
Yeah.
and they said, let's have some legislation in place. We can't let banks be self-regulated. We can't let this happen again. So they put in something called the Dodd-Frank Act. And that really clamped down on banks like anything. So
Okay.
there is supervision, there is regulation, there's stress testing of banks by the Federal Reserve, regular audits.
Okay.
These things, and they are supposed to hold more capital, they're supposed to hold more cash compared to before. So things have changed. Regulation has changed everything. Yeah. So quite a few differences in the way things happened 15 years ago and now. But one thing hasn't changed, which you actually mentioned earlier, which is banks are still susceptible to lack of trust. The whole reason why these financial institutions are still holding together despite short-term deposits and long-term loans, because people trust them.
That they will be paid.
Yeah, if everyone went and withdrew their deposits,
Yeah.
every bank in the world would collapse.
Yeah.
And I hope I'm not going to trigger a banking run by saying this. But there's no need to,
Yeah.
because the banks are inherently well-regulated, well-capitalized, as long as everyone doesn't go and pull out the money at the same time, which is
Yeah.
what happened in Silicon Valley Bank and some other banks in the US, right? So trust is the most important thing here. If one loses trust, then it goes out the window, which is a very funny way of saying, because you have this huge, complex, multi-trillion-dollar industry, and there's one thing that's holding it together, which is the linchpin of trust, right? It's very interesting.
But I mean, like with what happened with Silicon Valley Bank, the government stepped in and
Yeah.
kind of guaranteed all of the deposits.
Correct. Yeah.
So really, technically, you can't really lose your money, at least if you're in the US.
Well, yeah. A lot of deposits
Not
are still
if you're
not
in Lebanon.
or many countries they are not insured.
Okay.
So the Federal Reserve moved very quickly, right? Very quickly, the Treasury, the Fed, and the U.S. government has said we are insuring all the deposits, as compared to only certain deposits. I think only below $250,000 was insured.
That was insured, yes.
Before that, anything above that was not insured. But
Yeah.
now they said everything's insured. So they bailed out the banks. People have issues with that, saying you're actually encouraging banks to
They
take
bailed
more
out the
risk.
depositors.
Bail out the depositors,
Yeah.
not the shareholders though.
No.
Shareholders lost their money,
Yeah.
as they should, because
Yeah.
they're taking more risk. When
Yes.
you investing in equity, you're inherently investing in a very risky asset class.
Okay.
But depositors are investing their hard-earned savings. It's a liability for the bank. Yeah.
So lots of banks, four in the US, one obviously in Europe, Credit Suisse.
Suisse, yeah.
Is there fear of more? And what does it mean for us here in the GCC?
Well, the good news in the GCC, Loulou, is that banks here have always been well capitalized, lots of liquidity. And I'm going to break that down into, and you'll understand that by explaining a bank's balance sheet.
Okay.
Right? That's the best way of doing it. So if you take any bank's balance sheet, you have investments and loans on the asset side, and you have liabilities and equity on the other side. Let's take each one. I'll explain to you why the GCC banks are different,
Okay.
and why contagion most likely won't happen here. So if you look at the liability side, this is the deposits. These are you and me putting money in local banks here,
Yes.
right? But most of the deposits come from government or quasi-government institutions
Okay.
in government banks. Which is the second point. The ownership of these banks is mostly in the hands of the government itself, right? Without naming any names. So on the liability and equity side, everything is owned pretty much by the government, right? The government has no need to pull out deposits because it's their bank, it's their money, right? Where would they take it to anyway? On the asset side, for most banks, you have investments and loans. Now, loans in this part of the GCC, banks are very careful about giving loans, as you know, right? They insist on a lot of checks and collateral and blah, blah, blah. And a lot of the loans are also given to government companies. So again, that's covered, right? And thanks to the oil revenue, government companies are not in any problem of repaying their loans, right? If you look at investments, they all invest in bonds. Which bonds? Banks invest in bonds issued by government and quasi-government companies.
Yeah.
So you see, it's all very much a government-managed, controlled, owned situation,
Okay.
where retail investors or retail borrowers
Or very small.
very small. So and hence the chance of a panic or chance of somebody making some irrational decision and affecting the economy or the market is quite less. It's a very unique situation that we have in the GCC. So I would not say we should be scared of it. I mean, of course, there could be outlier events. us being affected by something happening on Wall Street or something like that. But banks are very safe here. I mean, the capital adequacy ratios, at the risk of sounding technical, the capital ratios of some banks here are probably some of the highest in the world, not just in the GCC or MENA region. Yeah.
Okay, so just to wrap up the point on inflation, so we feel it here. For example, I mean, our mortgages have gone up.
Yes.
What else? I mean, but on the other hand, you have the price of oil, which remains relatively high. It's lower than it was last year, but it remains relatively high, which
Correct.
I think is around $75
True.
a barrel. So what does that mean? I mean, so the price of oil is up,
Yeah.
but like you have interest rates going up as well. So things are
Correct.
getting more expensive. So
Yes.
what does it mean for people in the GCC?
So it really depends on which asset class you look at, right? So you have commodities, you have currencies, you have stocks, you have goods and services, for example. You're right. So goods and services prices have gone up. Not good for the individual like you and me. Petrol or groceries or home loans. So interest rates have gone up. That means home loans or any loan for that matter is more expensive,
Yeah.
right? Savers also suffer because if you are retired, I know not being retired people in this part of the world, but if you're retired, you're not getting any inflation-linked income anymore, just living off your savings, and that's being eaten away by inflation. So inflation is definitely very bad for consumers and savers, right? Even for investors, because the value of stocks, and we'll talk about that later probably, take a hit when you have huge inflation like this. The government sometimes benefits, which is weird, but when oil prices go up, right, in the situation, the government makes a windfall profit. So for the last 3 years, GCC economies have benefited hugely. GCC governments have benefited hugely because they had this huge inflow of money from the sale of oil and gas that came in because oil prices shot up, especially after the reopening that happened a couple of years ago, right? Yeah. They're now stabilizing. So it's a mix. It depends on who you look at. Are they benefiting? Are they losing? But from a consumer perspective, from a saver perspective, from an investor perspective, inflation is definitely not good. And the issue with inflation, Loulou, is we don't feel it that much. We still think, okay, we've got $1 million dirhams in the bank, and 5 years later, we still have the $1 million dirhams in the bank. Actually, you don't have $1 million dirhams in the bank anymore because the purchasing power of that $1 million dirhams has dropped. It's a concept that some people have difficulty getting their heads around because they say, hey, I've got $1 million dirhams. No, you don't have. Because what that $1 million dirhams could have bought 5 years ago is far more than what is going to buy you now.
Yeah.
So that's something that people need to understand, that leaving your money in cash under the mattress, under the pillow is not something very conducive these days. Yeah.
Yeah. So what do you do as an average person? That's a great segue. I was planning to ask you this later, but
Yeah.
But what do you do as the average person? I mean, a lot of us have investments, right? Like the equity markets are down, mortgages are up.
Correct.
Crypto, those of us who put some money in it, has collapsed. I mean, what do you do as the average person?
I was about to say put all your money in crypto, but you beat me to it.
I know you're not a believer. This is not investment advice.
Exactly.
I know you're not a believer in crypto.
So do you want me to talk about crypto first, or what to do with the money first?
What do you do with your money? I mean, with the current conditions globally, but here we seem to be okay. So what do you do as?
So I'm going to say something weird, which people may not be exactly thrilled to hear, but it's essential they hear it, which is that the most important advice about investing is not so much about what to invest in or how do you analyze investments, but more about psychology.
Okay.
And your temperament. Let me explain what I mean by that. So if I look at myself and my people I've taught and my colleagues, a lot of people know about investing. They know market. They know how to do a discount cash flow, for example. Or
not everybody, but
not everyone. Finance people, I'm talking about the finance world, right? These guys, the CFA charter holders, they know their stuff. And yet they make disastrous financial decisions, including myself in the distant past. And I think, why is that the case? And it comes down to temperament and behaviors and emotions.
Okay.
So maybe a few pieces of advice to your listeners, right? One is know yourself very well. And I know it sounds very cliched, know yourself. What does that mean? Well, know your risk appetite. Know your return requirement and risk appetite. So you might think, hey, I'm okay with losing X, but are you okay with getting half your investment wiped out? Think about that, right? When it happens in reality, it can be a gut-wrenching punch to you. So that's number one. Know your weaknesses. Know your biases. Know your
Maybe people
risk
think it
awareness.
won't happen, you know what I mean?
Yeah, they
Like
think they don't
because
happen.
the
Yeah,
markets, like if you look at markets, you've had a bull run for such a long time.
correct.
And now all of a sudden everything's down, so maybe people didn't expect, like, you know, they thought they were too smart and then realized that they were riding a wave.
So this is what in finance we call availability bias. You look at the available information, and what's available in your mind is what happened recently.
Yeah.
And what happened recently for the last 20 years, we've had what, zero interest rates,
Yeah.
and all asset classes are doing brilliantly. People haven't lived through a cycle yet. They're now going through it, right? So that's one advice. Know
So know
yourself.
yourself.
Know
And
yourself
your
is
risk.
your risk appetite,
Yeah.
your return requirements, your biases. Everyone has biases, and some biases are more destructive than others, right? Overconfidence being one of the most important biases. Like, I know everything. I've studied finance.
Yeah.
Blah blah blah. I've read these books. Okay, that's number one. I think number two, and this is not in any particular order, Loulou, right?
Yeah.
Just as a list. Number two would be, don't get into this FOMO habit. This fear of missing out.
Yeah.
Because at one point in Dubai, Rome, if you go to any dinner party in 2005, 6, 7, 8, all you heard was real estate. Somebody made money in real estate from this one.
Flipping apartments.
Flipping properties,
Yeah.
buying Porsches, buying luxury villas.
Yeah.
And people are strongly tempted to do that.
Yeah.
I would say just don't do that, because what's meant for somebody is not meant for you.
Yeah.
Again, goes back to my first point, knowing yourself. But FOMO is very powerful. It's a very powerful, how do you call, a phenomenon. I've seen it happen a lot of the time. Like,
Yeah.
let's all invest in crypto. Let's all invest in bitcoins. Or let's all invest in tech stocks. It's happening over time and again. And that's what builds bubbles, by the way. This FOMO fear of
That's what?
builds bubbles
Bill's bubble. Okay.
in any market, whether it's
Yeah.
crypto or real estate or anything else,
Yeah.
right? The third point would be think long term. I think people like to, think of money making as something very short term, trading mentality. And I'm yet to meet a trader who's made consistent profits over the long term. They always end up, for some reason, losing money. And the reason is not weird.
And this is someone whose job is to do that. So imagine
Exactly.
people that
Yeah.
that have other jobs and
Exactly.
are trading and
Yeah.
trying to do that.
So
Yeah.
traders try to do what day trading, right? Try to catch that day. They look at technical charts and all the fundamentals, and look at screens and shoulders and heads and things like that, which weird terminology, right? And they still spend like tons of time on the screen, and still end up losing money at the end of the day, right? Or at the end of the month. So that's another point. Think long term. People need to have a patient mindset. Building money takes time, very much. Yeah. The next other point related to that would be, so my advice in terms of asset allocation, where to put your money, would be right now, everything looks a bit dodgy. It's very uncertain, right? Tech stocks, we can talk about that later.
We said we can't put it under the pillow though.
We can't put it under the pillow though.
Yeah.
But weirdly enough, cash is becoming very attractive.
Okay.
Cash is king right now. Okay. Right now, guess how much you would get if you put your money in 1 year fixed deposits in the UAE.
I don't know. 5,
So-
6%?
Not 5, 6, but close, 3.5%, 4%.
Okay.
If you put your money in 1 year treasury bills issued by the US government, which are safe as you want to believe the US government is,
Yeah.
which is safe, you get 4.5%. This is 1 year, by the way. These are liquid investments.
Yeah.
It won't last for long, because once the rates come down, the Federal Reserve brings down the rates because inflation comes down, blah, blah, blah. But right now, 4.5%, riskless, virtually riskless, liquid investment is a pretty good deal for me, I would think, right? Other way of investing is to invest in index funds. Index funds, and a lot of them, right? S&P index funds and NASDAQ index funds. Basically, you invest in a bunch of stocks that a fund manager has collected and wrapped around and given to you. And just invest passively. It's called passive investing. Invest in them and forget about it for 3 to 5 years. It's not sexy. It doesn't make for sparkling dinner conversations. Okay?
Yeah.
You don't look like the brave guy at any event or in your office, but you'll make money over the long term. And it's basically you're just following the market. And over the long term, the market always does well. Over the short term, days, weeks, months, probably not, as you have seen over the last few years, right? But over the long term, if you look at the S&P 500, which is the most popular stock index in the world, it's been going up when you look at, say, over decades. So if you want to leave something behind for your kids, think about index fund probably more than, say, crypto or anything else, which is something, that's something else altogether.
Okay. Let's take a short break.
Yeah.
So let's talk a little bit about tech stocks. Everything's been down, from Amazons to the Metas to these great companies, also to the startups that IPO'd recently. So there's a report by CB Insights that that tracked basically the top 50 IPOs from 2020, beginning of 2020 till today. In the these 50 IPOs, they had a market cap of around 1.1 trillion. Today, they're down 59% collectively to around 450 billion. So there's a lot of destruction of wealth, right, happening. And there's a lot of companies, in that same report, they say that there was a slide from Silicon Valley Bank report just before it sort of collapsed. And it said that a lot of the startups were opting for venture debt versus raising equity at down rounds. So can you maybe talk to us a little bit about venture debt versus raising equity for startups, and what are some of the pros and cons for debt versus equity?
Right, sure. So maybe I'll start with the second point first, the pros
Okay.
and cons of debt versus equity, Loulou, right?
Okay.
From a company's perspective.
Okay.
Right? So what is debt and what is equity? Debt is basically a loan that you have to repay. Okay. Now it carries the interest, and you have to repay the principal at the end of X number of years. What are the pros of debt? The pros of debt is that you don't sell your equity. You're getting money into the company without giving away any equity, any ownership to anybody else. That's a huge plus. Okay. And of course, after some time, you pay back the money, and they're done. You're done with this lenders, right? The downside of equity of debt is that you have to pay the interest. It's a cash outflow for you. Especially for a startup company, cash outflows are not easy, as you very well know, right? It takes time for you to be cash flow positive. You don't even have profits, forget cash flows. So it becomes very difficult to service the debt. And then you have to pay the principal at the end of 3 or 5 or 10 years. So this cash outflows are not always possible for startup companies. Plus debt also, sometimes the banks or the lenders, they insist on certain very restrictive conditions, terms and conditions, like control over some assets or control over decisions of the management, which the management may not want to get into, right? So that's the pros and cons of debt, right? In terms of equity, it's like the flip side.
So it's basically cheap money because it's not diluting you as a founder. It's not diluting your ownership versus equity.
Yeah, exactly.
But you have to pay it back.
Yes.
And if you don't, then you're in
Exactly.
trouble.
Then you have issues with the lender. Your market reputation goes for a 6. Things like that.
Yeah.
It's very interesting. You mentioned one point, which is a hugely important point. Debt is actually cheaper than equity. People don't sometimes understand that. They think you're paying interest on debt. You're not paying anything on equity. So no, actually, equity is far more expensive than debt to service.
Yeah.
That's the biggest downside, I think, of equity. Apart from the fact that you're giving away a part of your business, is also one disadvantage of equity, right? Especially in the early stage, the valuations are not that high. So to get in money, you might just sell maybe 15, 20, 25% of the company, which 5 years later may be worth millions of dollars more. And I think, my God, why did I have to sell the equity so cheaply? But you needed the money.
Yes.
So you raised money through equity and sold it cheaply. The pros of equity is that is like the cons of debt. They are like flip sides, which are the mirror images of each other, which is that you don't have to pay any interest. You don't have to pay it back. Equity is permanent capital. You take the money, you keep it with you. Okay? There is no interest. Yes, there is dividend, what you pay shareholders, but that's completely up to the management of the company.
Yeah.
If you have enough
That
profits
rarely
and
happens,
cash.
honestly, in the
Exactly.
early days.
Yeah.
Like,
Early stages, it rarely happens. Dividend normally paid by mature companies like, IBM or companies like that, for example. That's a big advantage. There's no cash outflow, and it's permanent capital, and there are no restrictive conditions in terms of, like you have to give your assets for security or things like that, like you give to banks when they lend money to you. So those are the pros and cons of debt versus equity. But most startups prefer to take equity because it is less harmful to their cash flows.
and also, I think you have less requirements, probably. I mean, you could, if you convince the VC or the investor to give you equity, then you've convinced them. But
Correct.
to go and convince a bank to give you a loan,
It's very tough. That's not
it's,
what banks are there for anyway. That's not their model, Loulou, because their model is take short-term deposits and give loans to people who they know will pay back on time. Unfortunately, in their eyes, startups are extremely risky.
Yeah.
And they're probably risky
Well,
anyway.
they are risky.
They are risky.
Yeah.
So why would I give money, but I have to pay my depositors, so it's a big risk for me.
So what's going to happen now? I mean, if a lot of startups have taken on debt versus equity, and you have these kind of banks collapsing, at least in the US,
Yeah.
does that mean more? I mean, more like for you to service debt, and you're not going to be able to as a startup, you're probably going to have to lay off some people.
Yeah.
Some startups probably might not make it. So
Yeah.
we might see an even, I mean, I think this ripple is probably going to rip through for some time.
Yeah, absolutely. So one of the biggest fallouts from the Silicon Valley Bank collapse is the fact that, yes, the bank had issues, but that's not the issue. The issue is how it will affect the startup ecosystem in terms of funding available. Because if you go through Silicon Valley Bank's history for the last 40 years, they were the biggest venture capital debt funders, the biggest givers of what you call debt finance to startups, at least in the US. Now that source is dried out, and no other bank is there to replace that. So startups are going to face issues raising money that way. Plus interest rates are high anyway. So what do you do then? You have to basically raise debt at much higher rates from other sources of finance, or sell equity even more cheaply than before to get money in if you want to survive. Or if you have a loan from a bank, try and roll it over, try and extend the loan for a little bit longer to give you some more runway. I mean, the choices are not pleasant, to be honest, right now to most startup founders.
Yeah, we're seeing a lot of, we're seeing that correction ripple through here as well. I'm seeing it a lot back in 2020, 2021, the valuations for startups were really high. It was more of an entrepreneur's market. They were able to set the terms that they want, and everybody was kind of fighting to get in. I think the tides have shifted considerably. Valuations have dropped a lot. And investors are becoming more demanding.
Yes.
But it'll be interesting to see when will the good times roll again.
Well, it's interesting. I'm going to segue from the last remark you made. It's a good time for investors in a way.
Yeah,
they can become.
The
good times have already started. Depends on who you look at, right? So right now, good startups can be available for cheap for investors because they're desperate for money.
That's true.
And but to answer your question, let's go to the when do good time. Well, listen, if I had an answer to that, Loulou, I would be sitting in my yacht,
What's wrong with sitting
mood
here?
off a nice, lush tropical Caribbean island and sipping something.
Probably that's not what you want to do.
No, I don't think so.
I think if you know the answer, you'd probably be on some mountain climbing in the cold.
You're not far off from that, actually, to be honest.
Yeah.
I know I even said that one. Anyway, so I would be.
Yacht is not you. I think
No,
it's definitely not you.
Yeah. But that's a $1 trillion question. And it goes back to how we started this conversation is about what's happening in the US. Because like they say, when the US sneezes, the rest of the world catches a cold. It's so true. It's a $25 trillion economy. It's massive. And so many economies are linked to it in so many ways, especially in GCC, where our economies are linked to the US dollar.
Yeah.
So I think the question is, how long will the Fed continue in its tightening? That is key. And that itself opens up a host of other issues. But that depends on how persistent inflation is, which is dependent on the labor situation that we talked about in the US and some other factors.
Is that it? Is that like one of the main components of it, like the job vacancies? Or
yes. So basically,
there are more vacancies than people who are willing to take on these jobs, and that's driving prices up.
So there's a massive labor shortage.
Okay.
That's driving prices up, especially in the service economy, which people have started going to buy services after the reopening, especially.
It's interesting though. Like you'd think with this inflation and the rising rates that people would want to be working.
You would think so.
Yeah.
But I think they've got enough money in their banks.
Okay.
And I think also psychologically, from what I've read, COVID sort of changed a lot of people's perceptions of what work-life balance means.
Okay.
They suddenly found out that, I don't want to be working the same job 15 hours a day, earning a minimum wage, when I could be living far away from the city at a cheaper accommodation, enjoying life with my family and doing other stuff on a freelance basis, maybe. I think that has changed the mindset of millions of people. And then, of course, long COVID also hit. And a lot of people are suffering from long COVID. The estimate is about 3 to 4 million Americans are still going through the effects of long COVID. Yeah.
Wow.
And that's taken them out of the workforce as well. Okay. So the combination of all of this, reluctance to go back to work, long COVID, immigration policies, crackdown during the Trump era, as we know what happened, the consequences are there, has definitely affected the labor pool. So going back to your question, so good times, the macroeconomic policy is going to drive a lot of it, by which I mean what Jerome Powell and the Federal Reserve do in the US. He himself probably doesn't know what's going to happen next, to be honest, because there's so much uncertainty. Supply chain issues have been sorted out, but then you have a banking crisis coming up. So
supply chain issues are
still there, but not as bad as it was 2.5 years ago, when it was massive shortages thanks to the clampdown on China. China was going through a lockdown as well, and that's the world's factory. That has eased off a lot, right? So we have all these issues going on. So the answer is, when he decides to loosen or when he decides to pivot, is probably when the good times might roll again, and then there'll be more liquidity. Rates will come down, people will borrow more, invest more, lend more, things like that. till then, and I hope we don't end up in a recession because that's the worst possible scenario over the next 12 to 24 months. So if we have a soft landing and the Federal Reserve decides that the banking
So
crisis is
soft
solved.
landing means what?
So soft landing, so when the Federal Reserve raises interest rates, the biggest fear that the economists and the people have is that it'll crash the economy. Because when you raise rates, people can't borrow, they can't lend, and basically economic activity comes to a slowdown.
Okay.
That is the fear. It's still a bit of a fear now.
And then this will cause unemployment.
Yes,
This will cause lots of issues.
Exactly, it's a big
Yeah.
cycle, right? That's called a hard landing.
Hard landing.
Hard landing. And you can imagine someone falls hard,
Yeah.
hard landing, right?
Okay.
And
But is that a recession?
yes, pretty much a recession. That basically, Federal Reserve is deliberately causing a recession to cool down the economy and inflation. It sounds weird saying that, but like to cure the disease, you have to kill the patient. Not really. You bring patient to the edge of death and then pull him back.
Okay.
In a way, right? Sometimes the cure is worse than the disease. But anyway, so that's a hard landing, right?
Okay.
And that has happened 75% of the time when the Fed has hiked rates. So the prospects of a hard landing are historically, looking at historicals, are pretty high.
Okay.
A soft landing is opposite, where you achieve the magical combination of inflation coming down, but still the economy and the labor market
It's still hot.
being strong.
Or yeah. Okay.
So you want people to still be earning, still be employed, still to be spending. Because in the US, about 70% of the GDP is made up by consumer spending. So you don't want the consumer to put brakes on his spending. That will just crater the economy, right? So that's a soft landing. So if we get a soft landing, and if you have this banking crisis cooling down, everything under control, no contagion, blah, 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 and we have inflation under control, then I know too many ifs and buts here, but that's what we want to see, that the good times roll again, and people start investing and prices start going back up, before it comes down again. Because
So,
it's
but today we don't know if we're heading towards a hard landing or a soft landing.
We have no idea. The markets are hopeful that the Federal Reserve will stop hiking rates as early as June this year. They're actually probably factoring that into their calculations. I think they're being too optimistic.
Oh.
Because what happened in the 1970s, I love reading financial history. So if you go back to the 1970s, Loulou, there was hyperinflation.
Okay.
And there was
What's
called
hyperinflation?
hyperinflation is like, so let me give you an idea. Right now, inflation is at 6.5%.
Yeah.
In the late 70s and early 80s, they were in the 20s.
Okay.
So interest rate was 19% in 1981. Just to give you an idea, right now interest rates are 4.5%.
Okay.
And hyperinflation meant the interest rates had to go up a lot to kill inflation. That destroyed lots of industries, companies, and jobs, right? And that happened because the previous Federal Reserves in the late 60s and early 70s took their legs off the pedal. They basically pivoted too soon. They cut rates too soon.
Okay.
Before inflation was killed.
Okay.
Powell is he knows his financial history very well, and he knows that inflation is out of control right now. And he doesn't want the mistake of basically easing off right now and cutting rates or even stopping to hike rates too soon till the inflation is brought down to somewhere close to 2%.
And what happens if it's not brought down fully? And then, what happens if, let's say, they stop raising rates,
Right.
but then inflation keeps going up? Why is that a problem?
Well, if inflation keeps going up, we have several issues. One is that basically savings get destroyed. And there are a lot of pensioners and retired people out there.
So your purchasing power
Purchasing
goes down.
power of a lot of savers and everyone actually. The purchasing power comes down dramatically, right? That's going to be a big issue. People start losing faith in the Fed and the government. The Federal Reserve is supposed to be, the Federal Reserve in the US has two mandates. One is employment and second is regarding price stability. They're supposed to ensure price stability, i.e. control inflation. If they can't control inflation, suddenly you start doubting the efficiency and effectiveness of the government and the Fed. And that's not good for the credibility of any government or any central bank for that matter, right? So there's credibility issues involved. There is purchasing power loss involved. There is basically other issues that you have with inflation, which is basically unemployment could be there as well, right? Something could be very unaffordable. So you could start seeing inequality increasing. Only the rich people can afford a lot of stuff. The poor people cannot afford a lot of the stuff anymore. So the poor get poorer and the rich stay rich or even get richer.
Yeah.
And that's what happens in many hyperinflation economies. If you look at, say, Zimbabwe as extreme cases or Venezuela or even Lebanon.
Yeah.
The rich guys, I'm sure there are billionaires out there in their yachts and in their big villas. They don't really get affected by inflation because they got enough buffer. But the poor guys, they're getting crushed.
Yeah.
They have lost their jobs
Yeah.
and their salaries are not covering the expense
So
anymore.
going back to your historic example, so you're
Yes.
saying in the 60s there was inflation, but then they stopped hiking interest rates, and
Yes.
then it went out of
It
control.
went out of control, and then
Okay.
in 1981, this guy called Volcker, Paul Volcker, was a legendary Federal Reserve chairman. He came in, and he basically jacked up rates like crazy to 19%
Okay.
by 1981. By 1982-83, inflation was killed, but my God, he became a hate figure. So I was
Okay.
reading about him and the emails. There were no emails. The letters he got
Yes.
from people saying, from farmers, from small business owners, from startups, from companies saying, you killed my business. I had to lay off people. I couldn't afford the loans anymore.
Okay.
But he had to do it because there was no other way of breaking the inflation, which he did finally. And from 1983 or 84 till 2020, for about 26 years? For nearly 4 decades, we had low inflation because of what he did in those days, right? So Powell wants to sort of make sure that he doesn't repeat the mistakes of the guys before Volcker who made the mistakes in pivoting too early. And I think he's going to keep his leg on the pedals. So even after the banking crisis, which happened a month ago, right? Almost a month, 3 weeks ago.
Yeah, he still raised.
Exactly.
Raised
People are
the
saying,
rates.
oh no, it's banking crisis, contagion,
Yeah.
he needs to cool off. Rates went up. And that's exactly what I expected and exactly what he has to do. He did what he had to do.
But we could see more banks collapse. Basically.
We could see more banks collapse, but again, they would only collapse. Why? Because right now it's because the bond values have dropped, like we mentioned,
Yeah.
and people are withdrawing deposits. As long as you know that your deposits are fully insured, people will not, the contagion will not spread anymore. So that's the very smart move they made. Insure everything, right? all the deposits are insured. So it's not going to be a deposit. It's not going to be a banking run where people just withdraw billions daily. So I think that's been limited. We don't have toxic loans. We don't have too much leverage in the system right now compared to 2008. So I think it's under control. They've done a very smart job of doing it in Europe as well as in the US. But like I said, the fallout could be tightened bag lending, and that could result in less economic activity. But that's
And a
looking
hard
at-
landing.
and possibly a hard landing.
Yeah.
I hope we don't get there though. Yeah.
Okay. Well, let's pivot a little bit. I
Yeah.
think that was super helpful. So I just thought to ask you a little bit about some personal news. So you're
Sure.
working on a book.
Yes.
So you're taking all of these learnings and putting it in a book called Let's Get Real.
Yes.
Why Let's Get Real?
Why? That's a fantastic way. Why let's get real?
Yeah.
So let's get real because I'll give one liner. What got you here won't get you there. And I'm talking about careers. So this book isn't about finance or stocks.
about
No,
finance.
it's not about crypto or stocks or
No?
Federal
Oh,
Reserve or
you're not
Powell or
telling us
financial
how to get
history.
rich?
Maybe that's another book for that. I should write another book on that one, to be honest, given all what we discussed today, right? Interesting stuff. So this book is about my learnings, Loulou, and having 17 years of corporate life. Then I set up my own company, about 10 years of that, now into mentoring and coaching as well. And you see a lot of people, very smart people, bright people, well-educated people, not making it above a certain level in life, especially in careers. They remain at manager, senior manager level. And I think why? It happened to me at some point in my career before I got unstuck. And the reason is basically behavioral. We go back to the psychology point we talked about when you asked me for financial tips, right? So the book is all about the lessons I learned, divided into 4 chapters: knowing yourself, managing other people, and managing transitions, whether it's transition into entrepreneurship or transition into another role in your corporate career, with coaching tips for each of those. So I'm very excited because it's basically sharing my experiences, my views, practical suggestions. Yeah.
When is it out?
It's supposed to come out in May 2023, so probably about 6 to 8 weeks from now.
Okay.
There'll be a Dubai launch for sure. Dubai being my hometown in quotes after 20 years of being here. And hoping that you'll be there at the launch as well. Definitely you're getting an invite.
Absolutely.
And maybe you'll do a podcast on the book at some point in the future.
I was going to ask you, can you share a few, insights with the listeners so that they can look forward to go and buy the book?
Yeah, well, one main thing is, that I will repeat what I said earlier because it really merits repeating, is what got you here won't get you there, which is basically something that Marshall Goldsmith, the world's most popular executive coach, said in his book about 10 years ago, which is what the technical skills, the CA, CPA, CFA, MBA, engineering, whatever you had, will get you to a certain level in life. But beyond that, it's very behavioral. How do you manage yourself? How do you manage other people? How do you transition? How do you become self-aware? And that's something I struggled with in my own career, and somehow got unstuck through help from friends, mentors, coaches, and things like that. That's one important part. What got you here won't get you there. And you're your own best friend and your own worst enemy, to be honest, at the end of the day. There's no point waiting for help from outside, from your boss or colleagues or wife or husband or friends. You just have to be very grounded, look inside. So that's why the book starts off with know yourself. Just whether it's investing or finance or careers or leadership, you just have to know yourself. And it's very difficult for a lot of people to know themselves because it's very uncomfortable.
They don't want to know
They
themselves.
want exactly.
Yeah.
You know?
Who is this person? That's not me.
What am I going to see if I open the box?
Yeah, yeah.
But that's a must do because that's the foundation
How
for
do you
everything
open the
else.
box?
Experience, introspection, lots of reading.
You do it on your own or with help?
With help. So in my case, the unstuck phase, and we can talk about that later, but unstuck happened when people gave me feedback. And I wasn't aware of how I was
You were
behaving.
still in corporate.
I was still in corporate. I was actually running my company, Genesis, which you know.
Oh, you were running your company?
I was running a company when this thing happened. This transition happened about 8 years ago.
Okay.
And this is basically feedback that I got, which I used to ignore. But at some point, I decided that the company needed a leader, and that leader wasn't me. And I had to change. So it's a fascinating pivot that happened, which I had been ignoring for the longest time. But then some very critical feedback from the right people who delivered the feedback in the right way at the right time was hugely helpful. So that changed me. So I think it's a mix of many things. And I tell people, if you want to change, surround yourself with people who care about you and who know you and who are not shy of telling you that you suck at certain things. And that's the best thing you could do if you want to improve. And that worked for me. So the book is all about things like that, right? How do you get those people? How do you build that environment? How do you become self-aware? So it's a long journey, but I think it's really worth it. Yeah.
Well, looking forward to it.
Thank you so much, Loulou.
Yeah.
And I'm looking forward to seeing you at the launch event as well.
Love that.
And hoping that, the whole ecosystem will benefit from the insights in the book.
Thanks, Binod.
Pleasure, man.
Thank you so much for tuning into this episode of Conversations with Loulou with Binod Shankar. Don't forget to check out conversationswithloulou.com to listen to all the other episodes and to get links to where you can watch or listen to the podcast. If you want to reach out to me for sponsorships, for guest recommendations, or for feedback, you can do so through my website or on social media on all platforms at Loulou Khazen. Don't forget to subscribe wherever you listen to or watch the show so that you can get the latest episodes. And also, do leave us a rating and a review. It does help in getting the show discovered. See you in a few weeks.